I am Daren Lovell with Western AgCredit. I have been employed as a loan officer for 27 years, of which 22 years have been spent with Western AgCredit. I'm the branch manager in the Cedar City branch. Today I will be speaking regarding the types of loan products offered by Western AgCredit and to the agricultural industry as a whole. We have heard in previous presentations concerning the different types of assets. We have similar loans that pertain to the short-term loans, intermediate-term loans, and long-term loans. The first type of loans we have are operating loans. These loans are typically used for the day-to-day operating needs for crop production, harvesting expenses. They're also for livestock and feed purchases, and living expenses, taxes, and other agricultural and family expenses. Operating loans can consist of several different types. Budgeted operating loans are tied to a budget. The budget is established by the individual for their particular operating purposes, and the budget operating loan pertains to that budget. We also have revolving lines of credits. We also have non-revolving operating loans, which are for a specific purpose, namely for the construction possibly of a building, and then it is taken out by a long-term loan, or for other short-term loans that can be paid off within 1 year. The loan terms for operating loans, budgeted operating loans, typically have a 1-year duration. They are tied to a 1-year operating budget, and they are for the full amount of the budget. So the full amount is extended for the budget, and the money comes in and pays it down. Whereas a revolving line of credit can have a 1 to 3 year term, but the money revolves through the account over and over and can be used time and time again. If there is a FSA guarantee, a revolving line of credit can have a 5-year maturity. Intermediate term loans are typically set in place for 1 to 5 years, and they are available for the following purposes: farm machinery, both new and used, also for irrigation equipment and improvements. They can also be for production and processing equipment that has a longer period of time than 1 year. They can also be for building repairs and improvements. An intermediate term loan may also be used for refinancing other lenders. It can also be for herd expansion and for grazing permits that have a longer duration than 5 years. And they may also be used for any other agricultural purpose, which must be paid over a longer period of time. Intermediate term loans may also be for irrigation, typically for 3 to 7 years. Or we can go 10 years if they are secured by real estate. Long-term loans are typically for real estate purchases, facility construction, real estate improvements, water and irrigation projects. They can also be for debt refinance as it pertains to real estate that has a longer duration than the intermediate term loans of 5 to 10 years. And it can be for any other purpose, which is typically tied to real estate. We also have mortgage equity revolving lines of credits, or MRLOC loans. Now these are similar to a home equity loan that is tied to the real estate. It can be used for operating needs, but is tied to the real estate that serves as collateral. These revolving line of credits, or mortgage equity revolving lines of credits, can be utilized for any agricultural purpose or commercial purpose if the customer is a full-time farmer, and they will have a 5-year draw period, but they can be amortized from 15 to 25 years. Long-term loans, again, go from 5 to 30 years. They have fixed or variable rate options, and the repayment terms are typically tied to the income source, namely monthly, quarterly, semi-annual, or annual payments. We try to structure the payments as it pertains to the income stream. Repayment terms are typically tied to the income stream of when it comes in. For instance, if you have intermediate assets that you have purchased, namely livestock that was purchased at a higher price, you may want to pay that back in a shorter term rather than terming it over a 20-year period, as the life of the asset is only a 5-year for the cattle. You must be sensitive to the market and adjust your structure when market changes do occur. Again, you'll want to match the timing of your payments with the income stream. Some banks will require semi-annual or annual payments, or even quarterly interest payments, and these may not typically work with your income stream as you sell your assets once per year. By paying this quarterly, you may be paying interest on interest. Some of the repayment strategies that you will want to look at would be to first pay back your operating loans and lines of credit, including credit cards. These will typically have a higher interest rate than your longer-term loans. Second, you will want to pay off your small loans first. Third, you'll want to pay down or pay off your intermediate type loans. And fourth and finally, pay down your long-term loans. As you pay off the short-term loans, that money could be revolved through again, whereas if you pay off your long-term loans, you will not be able to revolve that money through. Now I would like to address the Young and Beginning Small Farmer Programs, or YBS. The purpose that Western AgCredit has for the YBS program is to establish or enhance business relationships with young, beginning, and small farmers with the highest potential for long-term viability and a long-term profitable relationship with the association. The goal is to provide constructive credit at reasonable cost to meet the special needs of these producers without creating undue risks to the association. Now, what is a young beginning farmer? A young farmer is one that has been in business or his age is less than 35 years. A beginning farmer has been in business for less than 10 years or 10 years or less of experience. A small farmer would be one who has less than $250,000 in annual sales. Now, the YBS programs are intended to help the YBS farmers who are committed to agriculture at similar rates and terms as would be offered to established or larger agricultural operations. These are generally used in conjunction with Farm Service Agency or FSA loans or guarantees. YBS individuals may face more challenges in obtaining credit than established larger operators. Young and beginning farmers typically have more similarities as a group than small farmers do. Due to the large capital needs of an agricultural operation, it is difficult for new farmers and ranchers to enter the industry unless they inherit an existing operation or acquire significant financial resources from other businesses that can be invested in the agricultural venture. Now, this is due to the fact that agriculture as a whole requires a large outlay of capital just to begin. Therefore, young and beginning farmers or producers often fail to have the financial resources necessary to meet a lender's underwriting standards. So how do YBS farmers differ from established or larger operations? Generally, they have little or no down payment or equity in collateral, which could be offered as collateral to the lending institution. They have a small amount of net worth, leading to higher leverage. They have limited history or inconsistent operations. And they have limited managerial experience. The general philosophy of Western AgCredit, as it pertains to the young and beginning farmers, is that a young or beginning farmer will be priced at a 2-step lower risk rating or probability of default, and as we indicate, a PD at a 1-step better loan collateral rating, full to limited or credit score analysis, and a lower rate than what they qualify for. As a small farmer, the analysis may be limited to a credit scored loan, which depends upon the credit score. Now, addressing some of the Farm Service Agency programs, they have both direct and guaranteed loan programs. Farm Service Agency, or FSA, has farm ownership loans, both direct and guaranteed. They have farm operating loans, both direct and guaranteed. They have land or contract guarantees. They have youth loans that can be done directly. They offer an operating loan for a microloan program which is less than $50,000. They also have emergency loans, whether there has been a designation of a flood or disaster or drought of any sorts in certain areas. They have conservation loans. These can be on a guaranteed basis. I would encourage you to look at the FSA website, which will be included on the slide. And they have many more programs which you can look at and research there. Direct farm ownership loans can be advanced up to $300,000. With a guarantee, a farm ownership loan can go up to $1,399,000. Now this is a combination of both direct and guaranteed loans for a maximum of the $1,399,000. And there can be various variations to the direct farm ownership programs. There are the down payment programs, the joint financing arrangement, which is called the 50-50 loan program. Some of the benefits of the farm ownership with the direct or guaranteed loan from FSA is it requires 0% down. They have lower rates and longer terms. Now the guarantees do require an upfront fee of 1.5%, which can be waived on a down payment option program. The FSA farm ownership loans for direct can be up to $300,000 and up to 40 years with 100% loan to collateral. Guaranteed loans of $1,399,000 can also go up to 40 years on their amortization with a down payment, a minimal down payment with additional collateral. Western AgCredit standards require a 65% loan to collateral and less than 30 years on their amortization. Now, the FSA does have the down payment program for both the YBS and the socially disadvantaged individuals. And this constitutes a 5% down, 45% will come from FSA, up to $300,000, and 50% from Western AgCredit. And this also can go up to $667,000. Now the FSA rate is going to be 4% below the direct farm ownership rate, but not less than 1.5% fixed on a 20-year term. With the 50-50 program, 50% will come from another lender, which must be in first lien position. And it can be on a 30-year amortization with a balloon at not less than 20 years. And FSA will guarantee up to 95% of this at no cost. Now, to qualify for this, you cannot have had more than 30% of the average county size farm at time of application. And this can be determined by visiting your local FSA office to see what this county average is for the size of the farm. Direct operating loans up to $300,000 can be used for normal operating expenses, typically machinery and equipment. Minor real estate repairs and improvements and refinancing debt are also considered an operating loan for FSA purposes. An operating loan can be a 1 year with terms up to 7 years. Now, if you obtain a guaranteed operating loan, again, it can go up to $1,399,000, and that is a combination of all direct loans from FSA and also guaranteed products. And they can have up to a 5-year approval on operating loans. Now with the FSA, there are also other products that can be used. There's a land and contract guarantees to the seller, and this will be used by FSA to guarantee a contract that a private party would have with the individual. This is typically for beginning and socially disadvantaged farmers only. And it would come with a guarantee of 90% of the principal outstanding for 10 years, or guarantee up to 3 amortized annual payments to the contract holder plus the cost of real estate taxes and insurance. This is limited to $500,000 with a rate of less than 3% above the direct farm ownership loan. But you must have at least 20-year amortization, and there can be no balloon before the 10 years. Again, as you have additional questions on this product, please contact FSA to inquire about their various programs. They also have other loans. Typically they'll have youth loans, which are direct. They can be up to $5,000 for both 4-H and FFA. They can be club calves and different items for both the young individuals. Those that qualify for this would be youth ages 10 to 20 years of age. Now, there are programs that Western AgCredit has for the young and beginning farmers, and typically we will use guarantees. We can use the FSA joint financing. We can use the FSA down payment program or no program with FSA where we will loan to you directly. Now, Western AgCredit will allow for lower standards to the young and beginning farmers. Those margins will be adjusted down even in light of the higher leverage positions and the higher advance rates on the collateral. We can give a reduction of 0.5% on the interest rate for the YBS concessions due to a guarantee that will help offset the FSA guarantee fee of 1.5%. Now, the livestock and equipment loans will have a seven-year limitation, and Western AgCredit cannot exceed a 70% advance rate. Western AgCredit will also allow for lower than standard margins and even higher leverage positions with an FSA guarantee on the 50-50 loan program. And if the 50-50 program is utilized, it can go up to 100% financing, as FSA will provide a second lien position behind Western AgCredit on their 50%. And the terms can be up to 30 years. Western AgCredit, however, cannot exceed 55% of the collateral, and we will allow for a lower than standard margin and higher leverage on the collateral. FSA can work up to 95% on their financing with a 5% down payment required, but that must have a 30-year term. Now, if Western AgCredit does not utilize the FSA program, we will require at least a 10% better than standard on the margin, and Western AgCredit will have to lower the liquidity and higher leverage positions for the customer. Operating loans in this case can go over up to 80% and over the normal of 70% and this would be the value of the farm production, and we can go up to 15 months utilizing the young and beginning farmer programs. Now, the equipment and livestock loans will have a 5-year limitation on their terms. We will have to utilize the normal underwriting standards and the collateral and financial ratios that typically apply to other customers. Western AgCredit can also offer a direct loan if there is an individual, a family member, or someone that would like to guarantee the loan to the individual. In this case, FSA can provide the direct funds, and that can be leveraged further with the guarantee. Now, this results in the size limits that are imposed on the young and beginning farmers to be removed. In the slide, you will see the current rates that apply to FSA programs. We can see that they are considerably lower than market rates, as they are tied to the cost of funds that the government has. Now, an example of how this can be applied to the purchase of a $600,000 purchase. Now, a standard Western AgCredit loan would be $210,000 down, which is 30%. And so you would borrow the $290,000 over 30 years at 6%, would be $21,000 per year. The standard Western AgCredit payment over 30 years would be $43,600 per year, and it would require a $982,000 worth of collateral or $382,000 worth of additional land. Now, if the Farm Service Agency down payment program is used, utilizing the 5% down, the 45% from FSA, and the 50% from Western AgCredit, that would constitute $30,000 for the down payment, $300,000 from Western AgCredit and $270,000 from FSA, the total combined payment would be $37,500 per year. And with the FSA 50/50 program with Western AgCredit of $300,000 over 30 years would be, again, the $21,000 per year. And the FSA 300,000 over 40 years at 2.5% would be $11,900, or a total payment of $33,400. You can see how this is less out of pocket for the customer if they go with the FSA 50/50 program, and the payment would be less. Now if we look at a $900,000 contract, again, Western AgCredit would require a $315,000 down payment. They would borrow $585,000 over 30 years at 6% would constitute a $42,500 payment per year. Now the standard Western AgCredit payment of over 30 years would be $65,400 and would require $1,390,000, or nearly $1.4 million worth of collateral for the additional margin that would be required on the loan. With the FSA 50/50 program, the FSA portion of $300,000 over 40 years at 2.5% would be $11,900 per year for the payment. Western AgCredit's portion of the $600,000 would be $43,400 per year for a total payment of $55,500. As you can see here, Western AgCredit can work in harmony with Farm Service Agency, providing the proper terms and structures that are important to your financial staying power. FSA and YBS programs, when used together, will allow for a greater critical mass of borrowing. Please contact your local FSA office if you have any questions regarding their programs, and please feel free to contact your local loan officer with Western AgCredit if you have any further questions about our structures, our loan programs, and our different terms that are available to you.